I'm here with Dennis Mitchell of Starlight Capital. Dennis, before the commercial break, we were talking about inflationary pressures, some of it being transitory, some of it not. I want to get your take on the supply disruptions that we're seeing as well, and whether that can work its way through.
Right. So the inflation that we're seeing now is very different from what, inflation that most of us studied in business school. Historically, inflation is created by an increase in demand. And so the way to combat that is to tamp down demand. What we're seeing right now is a lot of the inflation we're experiencing is driven by the supply bottlenecks that we're seeing. The COVID and the havoc that it's created in Asia, which is where a lot of global manufacturing is located, and then congestion at things like the port of LA. And so you combat that type of inflation very differently in that it is by design transitory. At some point, you're going to relieve the bottlenecks. At some point, we're going to be through the pandemic, and those supply disruptions are going to fade away. So I think, a lot of people are expecting the Fed to respond to inflation by hiking interest rates 4 times this year. I think they may be disappointed because I think the Fed is going to be data driven and they're going to see the supply bottlenecks and disruptions fading away. And that will put less impetus in their need to hike interest rates to combat inflation.
Okay. I want to switch gears and I want to talk about real assets because this is where you particularly pay a lot of focus. Real assets meaning real estate, as well as in infrastructure. Real estate is an interesting one, right? Because typically, if you look at REITs, they do well in a declining interest rate environment, but you're seeing good opportunities in REITs. Walk us through that.
Right. And so real estate and infrastructure both do well in declining interest rate environments. But surprisingly, and again, we have to talk about which interest rates are going up or down. The environment we're going to see in 2022 is policy rates going up, the short end of the yield curve. Our own thesis is that the long end of the yield curve is going to be anchored at between, call it 170 where we are now and maybe 2.25 max. And so in that type of environment, real estate and infrastructure should actually perform very well. And if we dig into what is actually happening in these businesses, you can see why. So if I look at traditional businesses, about 60% of their operating costs are tied to wages. And so with the wage inflation that you've seen, and again, it's at all levels of the organization. Walmart's paying $15 an hour, Amazon's paying $18 an hour. If 60% of your operating costs are tied to wages and they're going up that fast, well, you can see how corporate margins are going to be squeezed. And then at the same time, global growth is slowing because policy rates are going up, right? And so what you're going to see for traditional diversified businesses is revenues plateauing or the growth rate of revenues coming down at the same time that their operating costs are increasing materially. And so margins are shrinking, earnings per share growth is shrinking. And so as a result, they underperform real assets. And if you look at what happens with real assets, if long bond yields are sort of locked into 170 to 225, then the cost of debt for real asset businesses is not going up nearly as much as the cost of labor is for traditional businesses. And then when you look at the essential nature of the services provided by real assets, shelter, communications, transportation, power, water, well, the demand for those services is actually going to increase as global economies reopen and we go back to normal. So you have a situation for real assets where their revenues are going to continue to grow, where their operating costs aren't increasing nearly as much. You have margin expansion, cash flow growth, and the market will reward that with a higher multiple. And we should see real assets outperform traditional equities this year the same way we did in 2014.
So what pockets of REITs do you like? I'm assuming that office REITs, there's a lot of pressure there given this change in how we're working. What about, retail REITs or other REITs where you see better opportunity?
Yeah, regardless of the business, whether it's real estate, infrastructure, shoe retailers, what you want are companies that are growing their cash flows, right? And you start from the top and work your way down. You want to see companies that have pricing power, companies that are growing the number of units that they're selling. You want to see control over their costs. So when I take that screen and I look at real estate in particular, we really like industrial and multi-residential real estate. Why? Because again, the demand for that real estate is increasing. Rents are going up. And so again, your price and your units are increasing. And so your revenue is going up. And we've already made the point that the largest cost for real estate companies is the cost of their debt. Yeah. And if that isn't going up materially, then you're going to see cash flow growth superior to traditional equities and superior to the REIT industry. When I look at retail was already in structural decline. We had too much retail square footage per capita, and companies like Amazon that were embracing sort of e-commerce, and other companies like even Walmart with their purchase of Jet.com is embracing an e-commerce model. The need for bricks and mortar retail is coming down, and the pandemic has simply just exacerbated that.
Okay.
So we're not gonna see all retail REITs disappear and all retail physical real estate disappear, but the need for as much square footage per capita is coming down, and so we wouldn't be overly bullish on retail real estate.